Okay, how are you? Let's start. We want to start our first topic in this course. And the first topic is what we are calling the concept of double entry. And in this concept of double entry in business, we want to know what's the meaning of the term assets, what's the meaning of the term liability, and what is the meaning of the term capital. So before we know how to record the transactions in the books of accounts, we need to know what's the meaning of these terms. For example, what is an asset? What is an asset? In simple, we normally define an asset as anything the business owns. Anything the business owns is what we consider as an asset. Anything that the business owns is an asset. Anything that the business owns is what we consider to be an asset. This could include assets like stock, machinery, motor vehicle, and anything else that the business owns, that's what we consider to be an asset. So that's how we define an asset in simple terms. Anything that the business owns, e.g. stocks, machinery, motor vehicle, and so on. Normally in business, we classify assets into two categories. That means we want to talk about types of assets. We have two types of assets, or two categories of assets. Number one is what we call non-current assets. These are also referred to as fixed assets. Some books will call them fixed assets. Non-current assets, or what we can call fixed assets. Number two is what we call current assets. That's another type of assets, or another category of assets. So let's look at each one of them. What do they entail? What are the characteristics of what we are calling non-current assets? And what are the characteristics of current assets? Now, for non-current assets, these are assets that can stay in the business. For a long period of time. Any asset that can stay in the business for a long period of time, usually more than a year, more than 1 year. It can stay in the business for a long period of time, usually more than 1 year, and it is not usually for resale. It's not for resale. Any asset that can stay in the business for a long period of time, usually more than a year, and it is not for resale, that kind of an asset is classified as a fixed asset, or what we can call non-current assets. Think of an example of an asset that can stay in the business for a long period of time. Think of one and let me know. Think of an example of an asset that you think can stay in the business for a long period of time, and it is usually not for resale. It's not usually for resale. We can give examples like building. When your business has a building, that can stay in the business for a long period of time, and we normally don't buy the building for the purpose of reselling it. No. Another example could be machinery. That's another example of a fixed asset or a non-current asset. The other one could be motor vehicles. Good. These are just a few examples. We shall be knowing more as we proceed. We shall be knowing more as we proceed. So that's what we are calling non-current assets, or what you can call fixed assets. They are which kind of assets? Those assets that can stay in the business for a long period of time, usually more than a year, and they are usually not for what? Not for resale. That's what we give, or that's how we define what we call non-current assets or fixed assets. We are saying examples include machinery, motor vehicle, and buildings, for example. What are current assets? That's another type of assets. What are current assets? What are current assets? Current assets, what are they? These are assets that can stay in the business for a short period of time. These are assets that can stay in the business for a short period of time, usually less than 1 year. Usually less than 1 year, and they are easily converted into cash. Any asset that can stay in the business for a short period of time, usually less than a year, and it is easily converted into cash, then that kind of an asset is what we call, or we classify as a current asset, An example of a current asset could be stocks. When you have bought goods for sale, of course, that's what we call your stock, and you're supposed to sell it and convert it into cash within a short period of time. That is what we classify as an example of a current asset. The other one could be money in the bank. Whatever money you have in the bank, that should stay in the business for a short period of time, and it can easily be converted into cash. Another example of a current asset is what we call debtors. People who owe you money, they're supposed to pay you. You sold goods to them, maybe on credit, and they're supposed to pay you. We normally refer to them as debtors. We also refer to them as trade receivables. Those guys owe you money, and they're supposed to pay you within a short period of time. Those are debtors. We are saying they can easily be converted. They're supposed to pay you within a short period of time. Of course, another example of a current asset is cash itself. When you have cash in hand, that is considered to be a current asset. So we are defining current assets as those assets that can stay in the business for a short period of time, usually less than 1 year, and they are easily converted into cash. And we are giving examples here to include stocks, money in the bank, debtors, or what we can refer to as trade receivables, and cash in hand. Good. So that's one of the terms you need to know in accounting. That's one of the terms you need to know for us to learn this concept of double entry. That's one of the terms you needed to know. What's an asset? We have said it's anything that the business does what? Owns. Then we have said what are the different categories or types of assets. We have what we are calling non-current assets or current assets. We have said non-current assets are which kind of assets? Those assets that can stay in the business for a short period of time. Non-current assets are those assets that can stay in the business for a long period of time, usually more than a year, and they are not for resale. We have given examples like machinery, motor vehicle, buildings, and so on. Good. Then we have talked about current assets. Good. Now let's go to another term you need to learn or know, and that's the term called capital. What is capital? What is capital? I believe this is not a new term to you. You must have heard this term called capital. What is capital? What is capital? by simple definition, a simple definition of capital, we can say it is money or property required to start a business. Money or property required to start a business. That's in simple terms what we can define, or how we can define the term capital. It is money or property required to start business. Good. So that's another term you needed to know what it is before we look at how to do the recording in the books. That's another term. Another term you need to learn, another term you need to know is what we are calling liabilities. What are liabilities? What's a liability? What is a liability? Of course, you should have heard this term before. Again, it's not a new term to you. What's a liability? A liability, in simple definition, we normally define a liability as anything the business owes to others. Anything that the business owes to others, that's how we define a liability. It is anything that the business owes to others. Anything that the business owes to others, that's what we refer to as a liability. Again, there are different categories of liabilities or types of liabilities. There are different categories of liabilities, and that's what we want to talk about. Categories or liabilities. There are categories of liability. Again, one is what we call non-current liabilities. One category of a liability is what we call non-current liabilities. We can also call them long-term liabilities. We can also call them long-term liabilities. That's one category of a liability. The second kind or category of liability is what we call current liabilities. What we call current liabilities. So what are these kinds of liabilities? What are these kinds of liabilities? The first one is what we are calling non-current liability. What is it? It is that liability which will take a business more than a year to pay. Any liability that takes more than 1 year, to pay, that kind of a liability, we classify it as a long-term liability, or we refer to it as a non-current liability. We normally refer to it as a non-current liability. Any liability that takes you as a business more than a year to pay, any liability that takes you more than a year to pay, that kind of a liability is what we refer to as a long-term liability. What is an example? I hope you can be able to give me an example by now. Of course, we are saying, e.g., a bank loan. Maybe you took a loan from a bank which should be repaid within the next 5 years or 10 years. That kind of a liability is what we refer to as a long-term liability. Now we go to current liabilities. What are current liabilities? Again, I want to believe this is something you should be able to now say. So it is that kind of a liability which takes a short period of time. It takes less than 1 year to pay. That liability that takes less than 1 year to pay. That kind of a liability is what we classify as a current liability. When you have a liability that you owe somebody and you're supposed to pay it within a period of less than 1 year, that kind of a liability is normally classified as a current liability. For example, we have what we call bank overdraft. When you have overdrawn from your bank account as a business, when you have overdrawn from your account, from your bank account, we normally refer to it as a bank overdraft. You are supposed to repay your overdraft within a period of less than a year. Another example of that is what we can call creditors. These are people who supply goods to you on credit. People who supplied goods to you on credit, we normally refer to them as creditors. We also refer to them as trade payables. We also call them trade payables. Those suppliers that supply goods to you on credit, you're supposed to pay them within a period of less than 1 year. You're supposed to pay them within a period of less than 1 year. Good. So that's another term you needed to know, and that's what we are calling liability. And I've said a liability is what? It is anything that the business owes to others. In simple terms, anything that the business owes to others, that's what we refer to as a liability. Then we have said there are two categories of liabilities. One is what we call non-current liabilities or long-term liabilities. And we have said these are liabilities that should take you more than a year to pay. Any liability that takes you more than a year to pay, you as a business, that is what we refer to as a long-term liability. And we have given an example of a bank loan. When you take a bank loan for 5 years, 10 years, and so on. Then we have referred to another kind of a liability as a current liability. And we are saying these are liabilities that takes less than 1 year to pay. Any liability that takes less than 1 year to pay is classified as a current liability. And we have given an example like a bank overdraft, creditors, or what we can call trade payables. Those are suppliers that supply goods to you on credit. Good. Now, another term we need to know, in business before we look at how to record transactions is what are expenses. That's another term you need to know. What are expenses? Again, of course, I want to believe you must have heard this term. What are expenses? Now, we normally define expenses as costs incurred. We normally refer to them as costs incurred in the running of the business. Any cost incurred in the running of the business, that kind of a cost is what we classify or we refer to as expenses. Costs incurred in running of the business. Give me an example of an expense. Think of an example of a cost that is normally incurred in the running of the business. Cost incurred in the running of the business. Give me one. Obvious, one of them could be rent. You have to pay the rent of your premises. Okay. Another one could be electricity. You need electricity to run your business. Another one could be salaries and wages that you pay your workers. Another one could be insurance for your business and for maybe whatever it is, and many other costs that a business can be incurring in the process of running the business. Good. So those are the terms. I wanted you to understand them first before we know how to record transactions, in the sense that once a business has transacted, they need to record those transactions. That's why we are wanting to discuss the concept of double entry. We have not even started, but we just wanted to know the terms that will affect this topic, Okay. Before we look at the concept of double entry, I think now we can put down the summary notes. So let's put down summary notes now. So put down these notes. So the topic is concept of double entry. That's the topic. Then below that, you write meaning of assets, liability. You could even say meaning of assets, liability. comma, capital, and expenses. That's what you could even put it down. So put it down, meaning of assets, liabilities, capital, and expenses. Good. So let's put down the summary notes before we continue. After that, you can say below that, after that subheading, you have said meaning of assets, liabilities, capital, and expenses. Then you say this, assets, then you put a dash, assets or asset. Asset is anything that the business owns. Asset is anything that the business owns. E.g., stock, cash, machinery, motor vehicles, etc. So assets or asset is anything that the business owns. That's I hope what you are writing. E.g., stock, cash, machinery, motor vehicle, etc. Then another paragraph. There are two types. There are two types stroke. There are two types stroke categories of assets. There are two types stroke categories of assets. There are two types or categories of assets. There are two types. That's another paragraph. There are two types or stroke categories of assets. Number one, non-current assets, in bracket, fixed assets. Non-current assets, in bracket, fixed assets. Number two, current assets. Number two, current assets. Number two, current assets. Good. Another paragraph. Another paragraph. Non-current assets, put it down. Non-current assets are those assets. Non-current assets are those assets that can stay in the business. Non-current assets are those assets that can stay in the business for a long period of time. For a long period of time. For a long period of time. Usually more than 1 year. Usually more than 1 year. And are not for resale. 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 E.g., buildings, machinery, motor vehicles. E.g., buildings, machinery, motor vehicles, etc. etc. Good. Another paragraph. Another paragraph. Current assets. Current assets. Current assets. Then you say this, put a dash. Current assets, put a dash. These are assets. These are assets that can stay. These are assets which can stay. These are assets which can stay in a business for a short period of time. These are assets that can stay in a business for a short period of time. Usually less than 1 year. Usually less than 1 year. These are assets that can stay in the business for a short period of time, usually less than 1 year, and continue, and are easily converted, and are easily converted into cash. I've said these are assets which can stay in the business for a short period of time, usually less than 1 year, and are easily converted into cash, and are easily converted into cash. E.g., you can put down, e.g., stocks, debtors, cash, and bank. E.g., stocks, debtors, cash, and bank. Of course, when I say bank, I mean money in the bank. Okay? Good. Another paragraph. Capital. That's another term you need to know. Capital. That's another term you need to know. Capital. When you say this, put a dash. Capital is money. Capital is money or property required to start a business. Capital is money or property required to start a business. Capital is money or property required to start a business. Good. Another paragraph. Liabilities. Liabilities. Then you put a dash. Liability. Then you put a dash. Then you say this. Liability is anything that the business owes to others. Liability is anything that the business owes to others. Anything that the business owes to others. Then you say this. The following are the various categories of liabilities. The following are the various categories of liabilities. Following are the various categories of liabilities. 1. Non-current liabilities. Non-current liabilities. Stroke. Long-term liabilities. Non-current liabilities. Stroke. Long-term liabilities. Stroke. Long-term liabilities. You can put a dash next to that or below that. You can say this. These liabilities take more than a year, take more than 1 year. These liabilities take more than 1 year to be repaid. These liabilities take more than 1 year to be repaid. These liabilities take more than 1 year to be repaid. E.g., loans. You can put down that. E.g., loans. That's number 1. Number 2, current liabilities. Current liabilities. Current liabilities. Okay, then you say this. These are liabilities that take less than 1 year to be repaid. These are liabilities that take less than 1 year to be repaid. These are liabilities that take less than 1 year to be repaid. To be repaid. E.g., bank overdraft. E.g., bank overdraft, comma, creditors, stroke, e.g., bank overdraft, creditors, stroke, trade payables, stroke, trade payables, stroke, trade payables, stroke, trade payables. Okay, finish. We go to the next term that you need to know. Finish. We go to the next term that you need to know, and that is the term called expenses. 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 Then you say this. These are costs incurred. These are costs incurred in the running of the business. These are costs incurred in the running of the business. These are costs incurred in the running of the business. E.g., electricity, e.g. electricity, rent, telephone, e.g. electricity, rent, telephone, salaries, insurance, etc. etc. Good. Now we want to start the key issue now for the main topic now that you know what are these key important terms. So now we want to talk about the concept of double entry now. Listen carefully now. Listen carefully now. As a business, you normally incur some transactions. As a business, you normally incur some transactions. Those transactions should be recorded in the books of accounts. Those transactions should be recorded in the books of accounts. Now, we are talking of the concept of double entry. Listen, the concept of double entry. When we see a concept of double entry, we are saying every time you are recording a transaction in your books, every transaction must have two entries. Every transaction must have two entries. That's why we are referring to the concept of double entry. Now, before we look at how to record the transactions using the concept of double entry, before we look at how to record them in the accounts, you need to know what is the format of an account. What is the format of an account? This is format of an account. How does an account look like? So that when you are recording a transaction in that account, you know how to record it. Now, any account, listen carefully now, any account has two parts. Any account has two parts. The left side of an account, we refer to it as the debit side. The debit side, or the left side of an account, we normally refer to it as the debit side of that account. In short, we normally write it as DR. The right side of an account, you can see I've divided this account into two parts. Okay, the right side of an account, we normally refer to it as the credit side. In short, we normally refer to it as CR. Okay, every account must have a title. Every account must have a title. Every account must have a title. Good. So we have said an account has either what we call a debit side and the credit side. The right side of an account, any account, the right side of an account is referred to as the credit side, and the left side of an account is referred to as the debit side of an account. Good. Listen again. Each side, that means the debit side, has various columns again. We normally divide it into various columns. That is the left side of an account, or even the right side of an account. It has various columns. Same to the right side, same to the right side, same to the right side. So let me take it that we are dividing the account into two parts. We are dividing the account into two parts. That is the left side and the right side. Just a minute so that I make it clear. So we are dividing this account into that two parts. Those two parts. Good. Now, the right side of an account also has three columns. The right side of an account also has three columns. Now, the two sides are the same. The columns represent the same thing. The first column, we normally write the date. If you are recording a transaction on this account on the debit side, For the first column, you show the date. The second column, we normally show the details. Some books will call it particulars. Details. I'll talk about that in a short while. The third column, we normally show the amount of the transaction. In the third column of the debit side, we normally show the amount of the transaction. The same goes to the credit side. Again, you show the date of the transaction, when the transaction occurred. That's what you record on the column of the date. Then you have the column for particulars, or what I've called details. Then again, you have a column for amount. You have a column for amount. Good. Now, so which means the debit side and the credit side are the same. You start with the column of the date, the particulars or details, then the column of the amount. Now, I've already told you that every transaction that takes place in a business, you need to record it using a double entry. Listen, meaning that every transaction must have two entries. Listen, must have two entries in two different accounts. Every transaction that is recorded must have two entries in two different accounts. Listen. So what do you put under the column of the debit or the column of the date? You put the date when the transaction occurred. If the transaction took place on 1st of January, you come and say your 1st January. Under the column of the amount, listen carefully now. Under the column of the amount, you put the amount of the transaction. You put the amount of the transaction. It could be 2,000 shillings. It could be 3,000 shillings, whatever it is. What do you put under the columns of particulars or details? Listen, I've told you any transaction must affect two accounts. So if this is account A, for example, let's call it account number A. There is another account, let's call it number B, whatever the name of that other account. So under the column of particulars, you show the name of the other account. Listen, if this is account A, then you come and say the other account which was affected from that one transaction is account number B. So whichever B here, the name of the other account is what you put under the column of particulars. Same to the credit side. If you are recording a transaction on the credit side of the account, again, under the column of date on the credit side, put the date of the transaction. Under the particulars or details, we have said, give the name of the other account. Give the name of the other account that has been affected. Why? Because every transaction I've told you affects two accounts. We shall talk about that in details later, but I'm just showing you the format first. Good. Then, of course, under the column of the amount, you put the amount of the transaction. You put the amount of the transaction. Good. Now, before we continue, maybe you can copy this format of an account, because it's the format we shall be using in our recording. So just copy this format of an account. You don't have to have it a long one. No, just want you to know the format of an account. Just want you to know that an account, just wanted you to know that an account has two sides, the debit side and the credit side. Good. So put down this format, copy this format now. Take a minute and copy it, so that now we go ahead and apply the concept of double entry now. So that we go ahead and apply the concept of double entry. Good. So copy that format. Take a minute and you copy the format. Copy that format, so that we now start the key topic now. So we have said an account is divided into two parts. Don't forget, the debit side and the credit side. Whatever appears on the debit side is exactly what appears on the credit side. That's what we have seen. So the left side is called the debit, the right side is called the credit. So copy that format so that we now proceed to the next thing. Okay, you don't have to draw a long one. I've told you no. You don't have to draw a long one. No. So I hope you're through. I hope you're through. Good. Now let's continue now. So now we are coming to the key topic in accounting now. We are coming now to the key topic in accounting. That is the concept of double entry now. The concept of double entry. So let me introduce it. Let me introduce this concept of double entry. I've told you, listen, every transaction that takes place in your business will affect two accounts. That means you record two entries. That's why we call it double entry. Meaning, whatever transaction that takes place, two accounts will be affected. One will be, now listen, one will be a debit entry and another one will be a credit entry. Whenever transactions, listen, let me explain. Whenever you undertake a transaction, two entries have to be made. It could be one account, listen, it could be one account will have a debit entry and another account will have a credit entry, listen, or it could be one account will have a debit entry and the other one will also have a debit entry. It does not mean that one account will always be a debit, another one will be a credit. Get my point right. It could be both of them, both the entries will be a debit entry, or both of them could be a credit entry, or one of them could be a debit entry, the other one could be a credit entry. So the question is, how will I know whether to debit an account or to credit an account? We have rules. That's what we want to talk about now. Rules of double entry. Rules of double entry. So that is what I want to talk about now. What are the rules of double entry now? Because it is the rules that will tell you which account to debit and which account to credit. Now listen. If you have a transaction and that transaction affects an asset account, it affects an asset account, whichever the asset. Remember, we gave examples of assets like machinery, motor vehicle, furniture, buildings. This is anything that the business does what? Anything that the business owns. Listen now. So the rule of assets says, if an asset increases, if an asset increases, if an asset increases, you go to that account and debit. When an asset increases, the account is debited. If an asset increases, you do what? You debit that account. We shall look at an example. Then, if an asset decreases, if an asset decreases, the rule says you go and credit that account. So that is the rule of assets. That if you have opened an asset account from whatever transaction and you realize that the asset is increasing because of the asset of the business is increasing, then you go to that account and you debit. That's what we are saying. So in summary, we are saying here, when you open an asset account, it could be machinery, it could be motor vehicle, it could be whatever. We have already agreed. If that asset increases, you go to that account and do what? You debit. If an asset increases, you debit. And if an asset decreases, we have said you do what? You credit. That is the rule I want you to remember when it comes to rule of assets and double entry. The rule says that if an asset increases, you debit. And if an asset decreases, you credit whichever the account. Good. That's number one. What about liabilities? Or maybe we can talk about expenses. What's the rule of expenses? What is the rule of expenses? For expenses, we normally refer to also the rule of losses. Losses, the rule of assets and the rule of expenses and losses are the same. Losses and expenses are the same. Don't forget, we said expenses are costs incurred in the running of the business. Good. So what's the rule of expenses now? Listen, the rule of expenses says if expenses increase, expenses increases, you do what? You debit. That means you go to that account and you debit. If expenses increase, you go to that account and you debit. If expenses decrease, you go to that account and you credit. So that's the rule of expenses. That any time you open an expense account and you realize that the expenses is increasing, what have we said? What have we said? You go to that account and do what? And you debit. Okay, we shall do examples. Don't panic, but I just want to go through the rules first. What are the rules of these various types of accounts? Okay, so we have discussed the rule of assets. Now we are discussing the rule of expenses. And we are saying when an expense increases, the rule says you go to that account and you debit. When an expense decreases, you go to that account and you credit. That means whichever expense you have opened, if it increases, you debit. If it decreases, you do what? You credit. Good. That's our rule number 2 for expenses. Let me talk about the rule of liabilities now. Maybe you have a liability as a company or as a business. What's the rule of liability? What is the rule of liabilities? Now, again, listen, don't forget we said liabilities is anything that you do what? Anything that you owe to others, that's what we called a liability. Good. So the rule of liability states, if liability increases, you credit now. Listen, you credit the account. That's the rule of liability. If liability increases, you credit the account. If liability decreases, we say you debit the account. That's the rule of liability. Get the point there? That if liabilities reduce, you debit the account, and if liabilities increases, you go and credit the account, whichever the liability. Maybe your liabilities as a business are increasing. Go to that liability, whichever it is, and you credit. If the liabilities of your business are reducing, go to that account and you debit the account. We shall discuss, but the point is you now know what's a debit, you now know what's a credit. When I say you debit, you go to the debit side of the account and you debit. When I say you credit, you go to the credit side of the account and you enter the transaction on the credit side. So that's the rule of liability, which in summary we are saying any liability increasing, we have said you do what? You credit. Any liability decreasing, you do what? You debit. You debit. Good. So let me discuss the fourth rule, and that's the rule of capital now. The rule of capital. What happens when your capital of the business changes? When the capital of your business changes, what do you do? Now, the rule says, if capital increases, you credit the account. You credit the account. When you realize that the capital of the business is increasing, you're supposed to go and credit the account. And if capital decreases, you're supposed to go and debit the account. You're supposed to go debit the account. If the capital of your business is reducing or decreasing, you go and you debit the account. So that's the rule you should remember as far as capital is concerned, that when capital increases, when the capital of the business increases, the rule says you go and you credit the account. And when the capital of the business decreases, the rule says you go and debit the account. So that's the rule of capital. That's the rule of capital. What does it say? That for any capital account, if it increases, you credit. And if it decreases, you do what? You debit. If it decreases, you debit. Good. Finally, let's look at the last rule. Let us look at the last rule. That's number 5, the rule of revenue. We can also call it the rule of gain. What happens to revenues? When your revenue or gains increase, what is the requirement? So the rule says, if revenue increases, you go to that account and credit whichever the revenue of your business. If the revenue of your business is increasing, the rule says you go to that account and you credit. We shall do examples. Don't panic. We shall still do examples. But what I want you to remember are the rules, because this is the backbone now of accounting. This is the backbone of accounting. Without the concept or the rules of double entry, you may not know what we are doing. So it's important you follow or you understand the rules of double entry. And the rule says if revenue decreases, then you should go to that account and you debit. You should go to that account and you debit. Good. So that's the rule of revenue or gains. What have we said? The rule is saying if revenue increases, what do? If revenue increases, you credit. And if revenue decreases, you do what? You debit. Good. Now, those are the 5 rules I want you to remember, because they form the backbone of accounting. They form the backbone of accounting. How we record transactions in the books of accounts will always follow this concept of double entry. So it's important that you remember these rules, because it is the backbone of accounting. What have we said? We have said What is the rule of assets? The rule of assets says that when an asset increases, you do what? You go to that account and you debit. When an asset decreases, you go to that account and you credit. That's the rule of assets. The rule of expenses, we have said, when an expense increases, the rule says you do what? You go to that account and you debit. When expenses decrease, then you go to that account and you credit. Good. Listen, I hope you have noticed so far, I hope you have noticed that the rule of assets and the rule of expenses, the rule of assets and the rule of expenses are the same. I hope you have noticed that the rule of assets and the rule of expenses are the same. What's the rule? That if assets or expenses increase, you do what to the account? You debit. And if they decrease, you do what? You credit. That's the rule of assets and expenses. Good. I also hope you noticed as we were proceeding that the rule of liability, the rule of liability, the rule of capital, and the rule of revenue, I hope you noticed, again, they were the same. I hope you are noticing that the rule of assets and expenses are the same. 2, the rule of liability, capital, and revenue. The rule of liability, capital, and revenue are also the same, in the sense that if capital, if revenue, or liability increases, what do? If capital, if liability, if revenue increases, what do? You have said you credit the account. And if they reduce, that is capital, liability, and revenue, if they reduce, you do what? You debit. That's important to remember, because it is the rules that we shall be following every time we shall be recording transactions in the books of accounts. Okay? So with that idea now, I want us to start doing some examples on how to record those transactions. Examples on how to record those transactions. I hope you are clear about the rules. The way to remember them is just to remember that the rule of assets and rule of expenses are the same. And what have we said? When assets or expenses increase, you do what? You credit, you debit. You do what? You debit. And if assets or expenses reduce, you do what? You credit. Okay? And I've told you the rule of liability, capital, and revenue is also what? The same. In the sense that if they increase, the rule says you go to that account, whichever it is, and you credit. And if they reduce, that is what? Revenue, capital, and liability. If they reduce, you do what? You debit. Good. So before we look at examples, maybe we can put down the rules now. Let's put down the rules. So copy these rules now. Copy these rules. So have a subheading, rules of double entry. Rules of double entry. Copy them down. Copy them down now. We want to put them down now before we do examples on how to record some of those transactions. So copy them down. Copy those rules. Then you come and say assets, number 1. Assets, number 1. Then you can say if an asset increases, debit. If an asset decreases, you credit. Good. Hope you are through with that. Number 1. The rule of assets. If an asset increases, you debit. And if an asset decreases, you credit. Then you can put down that summary that I've shown in red, just to remind you the rule. You can show that summary, which is in red. Good. Then we go to the second rule, and that's the rule of expenses or losses. So you can copy the second rule now. You can copy the second rule. What does it say? It says, if expenses increase, debit. Next, if expenses decrease, you credit. Then again, you can show the summary of those. That is in red. That's a summary of that rule. You can show that CAT account. You can show that CAT account. If an expense increases, you debit. If an expense decreases, you credit. Good. Then you come to the third rule now. If you are through with the second one, now we can go to the third rule. And that's the rule of liability, which says what? If liabilities increase, you credit. And if liabilities decrease, you debit. If liabilities increase, you credit. And if liabilities decrease, you debit. I hope we are together so far. Then you can put down that summary now. You can put down that summary of the rule. That is the one in a T format. Okay? Yes. So that's the rule of liabilities. So if you're through with that copying, we can now go to number 4. What does the rule of number 4 say? That is the rule of capital. You can copy again. It says, if capital increases, what do? You credit. And if capital decreases, you debit. Capital decreases, you debit. So copy that rule now. And its summary there in a T account. That is the rule of capital. We go to the last one. That is the rule of revenue and gains. So I hope you're through with the number 4. Let's go to number 5 now. Let's go to number 5. So copy that number 5, the rule of revenue and gains. And you say this: if revenue increases, credit. And if revenue decreases, you debit. Then you can copy the summary now. You can copy that summary. That is, if revenue increase, you debit. If revenue increase, you credit. And if revenue decreases, you debit. Good. So I want us to go down and now, I want us to record a few examples of those transactions now, so that as we are looking at one example, we record it together. So let's do an example now. Let's do together an example. Examples. So you will be copying as I'm writing. Number 1, copy this. We want to look at a few examples. Put it down this. Started. One example. Started business. Started business with shillings 3 million in cash. Started business with shillings 3 million in cash on 1st January. Put down that example. It's a transaction that we want to record. It has taken place in your business. So how do you record it? We are told that you as an owner, you started business with 3 million shillings in cash on 1st January. Don't forget, we have said for every transaction, there must be 2 accounts. Okay, so I want to believe you can give me which 2 accounts have been affected here. And one of them, obvious, listen, one of them is what? Is cash. One of them is cash. That's one of the accounts that has been affected. Which is the other account you think? We started business with 3 million in cash. Listen, I told you, money or property required to start a business is called what? I told you money or property required to start a business is called what? Capital. Good. So the other account that will be affected, obviously, will be an account called what? Capital. Will be an account called capital. Good. Now let me analyze. Listen, let me analyze this transaction. Before we started the business had nothing. Get the point here? Before we started the business had nothing. Now you are looking at the business. Don't forget, we are looking at it from the point of view of the business. This transaction, we are not looking at it from the point of view of the owner. Listen, get my point here. Every time we are recording transactions, we are looking at those transactions from the point of view of the business. That means you take the business on its own and look at it. The business did not have money. Now it has cash of 3 million. Listen, where the money came from, we don't care. We are not recording the books of the owners. We are recording in the books of the business. Get the point here? We are recording these transactions in the books of the business. So you look at it from the point of view of the business, not from the point of view of the owners. No. Where he got the money, the business doesn't care. What the business cares is what happens in the business. Before we started the business did not have anything. Now it has cash. Are you getting? So the cash of the business did what? Went up or went down? The cash of the business went up or went down? Obvious, it went up. Remember, the business did not have cash. And I've told you, don't look at it from the point of view of the owner. Where he got the money, that's not our concern. But he has given the money to the business. So the money of the business has gone up. The cash of the business has gone up. So cash of the business has done what? Has gone up. Listen, at the same time, the business did not have any capital. Get the point here? At the same time, the business did not have any capital. And now it has capital. I told you, don't look at it from the point of view of the owner. Look at it from the point of view of the business. So from the point of view of the business now has capital. And therefore, the capital of the business has also gone up. Gone up. So though the two are increasing, listen carefully, though the two are increasing, that does not mean that you debit and you debit, or you credit and you credit. No. It is the rule of double entry. So you go back and find out, cash is what? Under which class of assets? We said cash is an asset. It is something that the business owns. And what did we say about the rule of assets? What did we say about the rule of assets? We said when an asset increases, what do? You debit. Good. So what you will do, you will come to this asset account. There will be a column of the debit, which I want to put there 1st January. I don't have to rule the rules. Of course, I'm hoping you're getting. I don't have to rule down the columns. It's assumed first column is the debt column. The second column I told you is for what? Is for particulars or details. Listen, and I told you, you show under the column of particulars, you show what? You show the name of the other account. We are recording in the cash account, which is this other account that has been affected. It is the capital account. So you come and now show capital. I said I don't have to draw the columns like this. No. You don't have to draw the columns to just separate. No. So I've shown the debit entry, or the first column is the date column. The second column, I show the name of the other account. Then I told you the third column is for what? The column of the amount. And the amount of the transaction is how much? 3 million. Good. So I've recorded in the asset account. Again, we go back to the rule of capital. It is the rule that will guide you. Whether you are debiting or crediting, it's the rule that will guide you. So we go back to the rule of capital. What does it say? The rule of capital said, when capital increases, what did we say you do? What did we say you do when capital increases? Here, we saw when capital increases, we said you credit. Sawa. Good. So we come here and we credit. So again, on the credit column, this of course you know it's a debit column. This is the credit side. This is the debit column. This is the credit side. So we come and put the date, which is 1st January. Put the name of the other account, which is this other account, cash. The second column is for particulars. Third column is for the amount. That is 3 million. Good. So you can now copy that transaction now and the recording. So we are given through with the example number 1. Put it down where we have said started business with 3 million in cash on 1st January. Good. So we are saying 2 accounts that will be affected will be cash and capital. Though the term capital is not in the statement, but the examiner for this wants you to know anything, money or property required to start a business is what we call capital. Good. So that's number 1. So finish, we go to number 2. So copy that example of that transaction and you show the recording. Copy that transaction, then you show the recording. Good. Now we go to the next one. Now we come to number 2. Copy this other example. Deposited shillings 1 million. Deposited 1 million, shillings 1 million into the bank account. Deposited shillings 1 million into the bank account. Deposited shillings 1 million into the bank account from the cash box. From the cash box on 2nd January. On 2nd January, copy that transaction now. Deposited shillings 1 million into the bank from the cash box on 2nd January. So copy that transaction so that we ask ourselves again, which 2 accounts are being affected and how do we record them? Good. Here, I hope you can see the 2 accounts. I hope you can see. This one is a bit direct. One of them is what? One of them, of course, is bank. Money in the bank affects bank account. 2, the other account that has been affected is an account called what? Cash. Good. So, but we go by analyzing the transaction first. we go by analyzing the transaction. You deposited shillings 1 million into the bank account. So the bank did not have money. Listen, the bank did not have money. Now it has some money. So the money in the bank has increased. So the money in the bank has gone what? Has increased. What about the cash of the business? Has it increased or reduced? The cash of the business. It's obvious the cash of the business has reduced. Once you do that analysis, get the point here again. Once you do that analysis, you have to go back and ask yourself, which kind of asset types of accounts are these? Bank is under which category of accounts? We have said bank is an asset. Cash is also an asset. It is something that the business owns. Good. So once you know that they are assets, then you go back to the rule of assets now. The rule says what? If an asset increases, you do what? You debit. So in the bank account, you come and say 2nd January. That's what we have agreed. The date column, show the date of the transaction. Next column is particulars or details. We said, what do you put under the details? The name of the other account, which is how much? Which is what? Cash. The third column we said is what? Amount. Show the amount of the transaction, which is 1 million. Good. The other one is cash, and it has reduced. The rule of asset says when an asset reduces, you do what? You credit. When an asset reduces, you credit. So we come and credit the cash account. We come and say 2nd January. Put the name of the other account, which is obviously bank. And the amount of the transaction again is 1 million. Good. I hope we are together so far. Good. We now go to the third example. So hope you're through. Hope you're through with that second example. Let's go to the third example now. Number 3. If you are through, you can copy number 3 now. Number 3, bought machinery. Shillings 1 million, paying, or we can say by check. Bought machinery shillings 1 million by check on 4th January. So copy that number 3. Bought machinery shillings 1 million by check on 4th January. Bought machinery shillings 1 million by check, 4th January. Good. Hoping again you can see the 2 accounts that have been affected here. Which 2 accounts? We have one called machinery, which is another name. What is the other account? If we bought machinery by check, we don't have an account called check. But what does it affect? When you pay by check, obviously it means you are affecting which account? If you are paying by check, it means you are affecting which account? It means you are affecting your bank account. Good. It means you are affecting your bank account because you are paying by check. Good. So let's record this. First, you analyze what happens to each of them. Again, listen. The business did not have a machinery. The business did not have machinery. Now it has, because it has just bought. Now it has machinery. That means it is increasing. Listen again. What happened to the money in the bank? What happened to the money in the bank? Obvious, the money in the bank reduced. The money in the bank must have reduced because you are paying by check. So again, you go by the rules. Machinery is something that the business owns, which is an asset. Money in the bank is something that the business owns, which is an asset. So let's go by the rule of double entry concerning assets. When an asset increases, the rule says you do what? You debit. So you will come to your machinery account. You will come to your machinery account and you debit. This is 4th January. Put the name of the other account, which is bank, and the amount is 1 million. Then you go to the second account, which is an account of the bank, which has reduced. And money in the bank being an asset, the rule says when an asset decreases, you credit. So you come and see here 4th January, put the name of the other account, which is machinery, and we have said you credit. That is by 1 million, the amount of the transaction. Good. So we are through with that example. So copy, we want to go to the 4th example. Copy, we want to go to the 4th example now. Copy, we go to the 4th example. Yes. I hope you are through. I hope you are through. Now let me go to number 4. So copy this 4th example. On 5th January, purchased office equipment. On 5th January, purchased office furniture. Let's call it office furniture. Shillings 500,000 on credit from ABC Furniture Limited. From ABC Furniture Limited. From ABC Furniture Limited. So copy that example so that we see how to record it. We are told on 5th January, you purchased office furniture, shillings 500,000, sorry, on credit from Furniture Limited. Good. I want to believe you can already see one of the accounts that is being affected. Which one? One of the accounts being affected is which one? If we purchased office furniture, then it is obvious one of the accounts being affected is an account called office furniture. You bought office furniture, so it will be affected. Listen, this time you are not paying immediately. You will pay later. So you are buying it on credit. You are buying it on credit. And you are buying it on credit from a company called ABC Limited. Listen. So it means you owe ABC Limited that 500,000. So listen. So to you as a business, you have a liability to who? You have a liability to pay to who? To a company called what? ABC Limited. So you will open that liability account by the name of the company. So you come and say here, ABC Furniture Limited. ABC Furniture Limited. So just to remind you, you can show in bracket liability. Just to remind you that it's not something you own. It is something you owe. It is something that you owe to ABC Limited. It is something that you owe to ABC Limited. Good. So let us analyze the transaction again. Let us analyze that transaction. from the point of view of what? The business. From the point of view of the business, what happens? The business did not have any furniture before. Listen, the business did not have any furniture before. Now it has furniture. That means the furniture of the business has gone up. Listen also, at the same time, the business did not owe anybody anything before. Before they bought this machine or this amount of furniture, they did not owe anybody anything. Now they owe a company called ABC Limited some money. Meaning that the liability of the company or the business has also gone what? Has also gone up. The liability of the business has gone up. So both of them are increasing. But I told you that does not mean that you go debit or credit. No. Listen, it is the rule of double entry that will guide you on whether to debit or to credit. It is the rules of double entry that will guide you on whether to debit or to credit. Remember, we said, what does the rule of assets say? Because furniture is an asset. And we said when an asset increases, the rule says you do what? You debit. Good. So let's go to your furniture account. When did we buy? On 5th of January. That's the date of the transaction. 5th January. Put the name of the other account. That is ABC Furniture Limited. ABC Furniture Limited. How much is the amount? 500,000. That's how we are recording on the furniture account. The asset has increased. The rule says you debit. Asset has increased and the rule says you debit. Good. Now we go to the second one. Now we go to the second account, and that is the account of ABC Limited. Here is a company you owe money to. And the rule of liability says when liability increases, what do? What did we say about the rule of liability? Remind me. What did we say about the rule of liability? We said when liabilities increase, you credit. I hope you remember. We said when liabilities increase, you do what? Where was that rule? Here it was. You can see it there. The rule said when liabilities increase, you credit. So let's go and credit that liability account. Let's go and credit that liability account. You come and say here 5th January. Put the name of the other account, which is what? Office Furniture. And the amount of the transaction is 500,000. Good. So that is all for that example. That's all for that example. So finish. We go to the next one. Maybe we do a few more. Then we shall do some more next lesson. So finish. Maybe we do one more. Then we shall do a few more next lesson. Okay. So that was number what? Number 4. Now we can record number 5. We can record number 5. On 7th January, sold furniture, sold office furniture, let's put it that way, sold office furniture, shillings 100,000 by cash. By cash. Sold office furniture, shillings 100,000 by cash. By cash. So which two accounts do you think are being affected? Which two accounts do you think are being affected? One again is what? I hope by now you're getting something. One of them is cash. That's one of the accounts being affected. For every transaction, there must be 2 entries in 2 different accounts. So one is cash, the other one is what? What is the other account? Of course, office furniture. Good. So we look again and analyze what happened. If your business sold office furniture, then the furniture of the office reduced. Are you getting? Yes. The office furniture reduced. Now it doesn't have furniture. Furniture of the office reduced. That means assets of the business. We sold and we received cash. We sold and we received cash, meaning our cash was increasing. So we come and say our asset is increasing. Cash. Good. So go by the rules again. What does the rule of assets say? Rule says when an asset increases, cash is increasing. The rule says you debit. So we come to the cash account and we say 7th January. Put the name of the other account. It was in the second column. That's what we said. Office, furniture. Third column we said is put the amount of the transaction, 100,000. Good. That is on the account of asset. That the asset called cash has increased because we did not have it. Now we have cash. We received cash when we sold the furniture. Good. At the same time, as a business, we no longer have furniture. So our furniture has reduced. Furniture is an asset. It's something that we own. Therefore, assets have reduced. We credit. We come and say 7th January. That's the date of the transaction. We say the second column we put what? The name of the other account under the column of particulars. And the other account that has been affected in this transaction is cash. Then we show the amount of the transaction. That is 100,000. That is 100,000. Good. So that's all. Maybe for today we can stop there. Next lesson, we go ahead with a few examples. Then we shall develop the topic as we are doing. So I'll do a few more examples next time because we still are yet to cover other areas of different types of accounts. We have covered some areas on the accounts, on different types of the accounts, but we have not covered all of them. So we still have to do some more practice looking at a variety of transactions. Once I talk about, or once we do a variety of examples next time, then I will develop the topic. So for today, see you next time. So bye for now. See you next time. Okay.